Before we begin, a quick and important disclaimer. The following content is provided strictly for educational and entertainment purposes and does not constitute professional legal, financial, or tax advice. The division of retirement assets, specifically 401k accounts, involves complex federal and state regulations, including the Employee Retirement Income Security Act, ERISA. Every individual case is unique, and laws vary significantly by jurisdiction. You should not act upon this information without consulting a qualified attorney, a certified financial planner, or a tax professional. We encourage all viewers to conduct their own due diligence before making any decisions regarding their marital assets or retirement planning. Imagine a couple standing in a courtroom, not arguing over who gets the dog or the mid-century modern sofa, but over a digital balance in a Fidelity or Vanguard account. For 30 years, they shared a dream of a quiet retirement in the Pacific Northwest, fueled by automatic payroll deductions and the steady climb of the S&P 500. Now, that fortress of compounded interest is being split down the middle by a document known as a Qualified Domestic Relations Order. In the world of modern American literature, the 401k has become the ultimate symbol of the broken social contract. It is the ghost in the machine of the suburban tragedy. While the Great Gatsby obsessed over green lights and old money, the modern literary protagonist is haunted by the potential outcomes of a pre-tax asset liquidation. We are entering an era where the most high-stakes conflict in a novel isn't a duel or a secret affair. It is the forensic accounting of a life's work. This video is the first in a 10-part masterclass where we are going to deep dive into how American fiction mirrors the brutal, technical, and often heart-wrenching reality of the 401k divorce. This series solves a specific modern problem for the American audience: the total lack of narrative context for our most valuable assets. Most of us understand that a 401k is a retirement tool, but very few understand how it functions as a character in our personal histories, or what happens when that history is legally severed. By examining case studies through the lens of literature, we will help you understand the historical trends that moved us from guaranteed pensions to the individual burden of the 401k, and the step-by-step technicalities of how these assets are actually divided in the real world. This is not just about money. It is about the stories we tell ourselves about security, and what happens when those stories require a rewrite. To understand the 401k in literature, we first have to understand the massive historical shift that occurred in the late 20th century. Before the 1980s, the retirement story in American fiction was usually centered around the pension. In classic mid-century novels, you see characters like Willy Loman or the men in John Cheever's stories who are tethered to a company. The company promised a defined benefit. You put in your time and the company took care of the math. But the introduction of the 401k in 1978, and its subsequent explosion in the 1980s, shifted the narrative burden onto the individual. This created what literary critics call the internalization of risk. Suddenly, the protagonist wasn't just a worker. They were a fund manager. This change fundamentally altered the divorce novel. When we look at modern masters of the suburban domestic drama, such as Jonathan Franzen or Taffy Brodesser-Agner, the 401k isn't just a line item. It is a source of immense psychological tension. In these stories, the 401k represents the deferred life. The characters sacrifice their present happiness, staying in loveless marriages or soul-crushing jobs, specifically to maximize their future tax-deferred growth. When the divorce finally happens, the tragedy isn't just the loss of the partner. It's the realization that the future they were saving for has been cut in half. Let's look at the technical step-by-step of this literary and literal nightmare. The Qualified Domestic Relations Order, or QDRO. In a deep-dive analysis of marital dissolution, the QDRO is the climax. You cannot simply log into your portal and Venmo your ex-spouse half of your retirement funds. If you did that, the IRS would treat it as a premature distribution, hitting you with immediate income tax and a potential 10% penalty if you are under age 59 and a half. In literature, the QDRO acts as the legal ritual that finalizes the separation of two lives. The process begins with discovery. This is the phase in a novel where the secrets come out. In a financial context, this involves producing every statement, every contribution record, and every loan document associated with the 401k. A key point of contention in many case studies is the premarital portion. If a character started their 401k 5 years before the wedding, that initial seed money and its subsequent growth might be considered separate property, depending on the state's laws. However, the marital portion, everything contributed from the day of the I do to the day of the I'm done, is typically subject to an equitable split. Once the value is determined, the QDRO must be drafted. This isn't a standard court order. It's a highly specific document that must be approved by both a judge and the plan administrator of the employer. This is a crucial detail that authors use to show the bureaucracy of heartbreak. The plan administrator acts as a gatekeeper. If the QDRO is not drafted with the exact technical language required by that specific 401k plan, it will be rejected. This can lead to months or even years of administrative limbo, a recurring theme in contemporary stories about the American middle class. The actual division of the asset usually follows one of two paths: the shared payment approach or the separate interest approach. In the separate interest approach, which is common in literature involving younger or mid-career couples, the account is literally sliced in two. The alternate payee, the ex-spouse, gets their own separate account within the plan, which they can then roll over into their own IRA. This provides a clean break, a narrative new beginning. However, the emotional weight comes from the loss of compounding. When you take a $1 million account and turn it into two $500,000 accounts, the growth trajectory changes. The characters are forced to reckon with a downgraded version of their imagined future. We see this play out in the silver divorce trend, couples divorcing after age 50. In these case studies, the 401k division is often catastrophic because there isn't enough time left in the work sequence to replenish the funds. Authors use this to explore themes of mortality and regret. The 401k, which was supposed to be a bridge to freedom, becomes a reminder of how much of their life was traded for a number that was ultimately insufficient to support two separate households. Another deep dive element is the 401k loan. This is a classic Chekhov's gun in modern financial fiction. If a character secretly took a loan against their 401k to fund a failing business or an affair, that loan must be accounted for during the divorce. Often, the loan is treated as a distribution to the person who took it, meaning their share of the remaining pot is reduced. This creates a moment of financial reckoning that serves as a powerful metaphor for the hidden debts we accrue in a relationship. As we move through this 10-part masterclass, we will examine specific chapters of American literature that highlight these historical trends. We will look at how the shift from community property states to equitable distribution states changes the stakes for fictional characters. We will analyze the tax trap, where one spouse gets the house, a post-tax asset, and the other gets the 401k, a pre-tax asset, unaware that they aren't actually receiving equal value. The 401k divorce is the quintessential American story because it combines our two greatest obsessions: the pursuit of wealth and the pursuit of personal reinvention. It is the point where the cold math of the IRS meets the messy reality of human emotion. By the end of this deep dive, you won't just see your retirement account as a balance on a screen. You will see it as a narrative arc, a complex legal entity, and perhaps the most important document you will ever sign. We are going to show you how to read between the lines of your statements to see the potential outcomes of your own financial story. Stay with us as we peel back the layers of the American dream, one contribution at a time. To truly grasp why the 401k has become the primary antagonist in the modern American divorce novel, we have to look at the math that underpins the tragedy. In the year 2026, we are seeing the culmination of a 40-year experiment in privatized retirement. For decades, the narrative of the American household was based on the idea of the marital unit as a single economic engine. But when that engine stalls, the technicalities of the Internal Revenue Code Section 401k transform from boring financial footnotes into weapons of total domestic destruction. Let's look at a case study involving a fictional but highly representative couple, Michael and Sarah, living in a high-cost suburb of Chicago in 2026. After 22 years of marriage, they decide to part ways. Their primary assets are a primary residence valued at $750,000 with a $300,000 mortgage, and Michael's 401k, which has grown to a substantial $900,000. In a standard mediation, a couple might look at these numbers and suggest a simple trade. Sarah wants to keep the house to provide stability for their teenage children, and Michael agrees to let her have the $450,000 in home equity if he gets to keep his $900,000 401k. On the surface, Michael looks like he is winning the negotiation. He is walking away with double the nominal value. However, this is where the pre-tax illusion creates a narrative pivot that authors like Jonathan Franzen love to exploit. A 401k is not a bucket of cash. It is a bucket of future tax liabilities. If Michael's 401k is entirely pre-tax, every dollar he withdraws in retirement will be taxed as ordinary income. If we assume a historical trend of a 25% effective tax rate in his retirement years, that $900,000 is actually worth only $675,000 in spendable terms. Meanwhile, Sarah's home equity is a post-tax asset. Thanks to the Section 121 exclusion, she can potentially sell that home and keep up to $250,000 of the gain tax-free. In this case study, the person who thought they were taking the larger share of the pie is actually absorbing a massive, invisible debt to the federal government. This technical disparity is what we call the valuation trap, and it is the moment in a story where the protagonist realizes their perceived victory was actually a strategic defeat. In American literature, this realization often serves as the dark night of the soul. The character realizes that the financial literacy they spent years cultivating was incomplete. They focused on the contribution phase, the steady, disciplined accumulation, and completely ignored the distribution phase. In a divorce, you are forced to perform a forced distribution analysis decades before you actually retire. To understand the mechanics of how this plays out in a courtroom or a lawyer's office, we must examine the Majowska's formula, a specific legal calculation used in various forms across many U.S. states. This formula determines the marital share of a retirement asset.
Immagine a ti Meline.
Michael started his job in his 401k in 2000. He married Sarah in 2004. They are divorcing in 2026. The court must determine what portion of that $900,000 was earned under the cover of marriage. The calculation is a fraction. The numerator is the number of months the couple was married while the 401k was being funded, and the denominator is the total number of months the participant was in the plan. In Michael's case, that is roughly 22 years of marriage out of 26 years of employment. This means nearly 85% of the total value is considered marital property, even if the account is in Michael's name only, and even if Sarah never contributed a cent of her own income, she is legally entitled to half of that marital portion. In literature, this fraction represents the quantification of love. It is the cold, hard number that tells a character exactly how much of their professional life belongs to someone they no longer wish to speak to. Now let's introduce a second, high-stakes scenario involving a 401k loan. Imagine James and Linda, a couple in their early 50s. James, sensing the marriage was failing in 2024, decided to take a maximum loan from his 401k, $50,000, to fund what he called a business investment. In reality, he used the money to sustain a lifestyle he couldn't afford or perhaps to hide assets. By 2026, when the divorce papers are filed, that loan is still outstanding. Under the rules of most 401k plans, if James leaves his job or fails to pay back the loan, it is treated as a deemed distribution. This triggers immediate income tax and, if he is under 59.5, a 10% early withdrawal penalty. During the divorce, the court has to decide who is responsible for that phantom $50,000. Was it a marital debt used for the benefit of the family? Or was it dissipation of marital assets? If the judge rules it was dissipation, James may find his remaining share of the 401k reduced by the full $50,000, while he still owes the tax and penalties to the IRS. This creates a double jeopardy situation that serves as a powerful cautionary tale in modern domestic thrillers. It shows that the 401k is not just a savings account. It is a legal contract with the government that can be breached with catastrophic consequences. The technical process of actually splitting these accounts adds another layer of tension. The Qualified Domestic Relations Order, QDRO. This is a specialized legal document that must be drafted with surgical precision. It is the only way to move money from one person's retirement account to another's without triggering those devastating taxes and penalties. The step-by-step process of a QDRO is a masterclass in American bureaucracy. First, the lawyers must obtain the Summary Plan Description (SPD) from the employer. Every company, from Google to a local manufacturing firm, has different rules for their 401k. Some allow for immediate segregation, where the ex-spouse gets their money right away. Others require the ex-spouse to wait until the participant reaches retirement age. Imagine the narrative conflict. A 45-year-old woman is legally awarded $200,000 from her ex-husband's 401k, but the plan rules state she cannot touch a penny of it for another 20 years. She is paper-rich but cash-poor, a theme that resonates deeply with current economic anxieties of the American public. Next, the QDRO must be sent to the plan administrator for a pre-approval. This is a nervous waiting period for the characters. If the administrator finds a single typo or a violation of the plan's specific language, the order is rejected. It's back to the drawing board, back to the lawyers, and more money out of the pocket. Once approved by the plan, it goes to the judge for a signature, and finally it is served back to the plan for execution. This cycle can take 6 to 12 months. In a novel, this delay allows the tension to simmer, as the ex-spouses are forced to remain financially tethered long after the emotional bond has dissolved. Historical trends show that as we moved away from the defined benefit era pensions into the defined contribution era, 401ks, the emotional weight of divorce changed. A pension was a promise of a future check. A 401k is a pile of money that exists now. It feels more real, more touchable, and therefore more painful to lose. We are seeing this reflected in contemporary literature, where the account balance becomes a surrogate for a character's self-worth. When that balance is halved, their identity is halved. But what happens when the 401k contains more than just stocks and bonds? What if it contains company stock? This introduces a whole new level of complexity, known as net unrealized appreciation, NUA. This is a potential outcome that very few people, and even fewer fictional characters, understand until it is too late. If a 401k contains highly appreciated company stock, there are specific ways to distribute it that can significantly lower the tax burden. But if the divorce settlement doesn't account for NUA, the couple might accidentally burn thousands of dollars in tax savings. This is the ultimate tragedy of ignorance that underscores the need for deep-dive financial literacy in the modern age. As we conclude this part of our masterclass, we have to look toward the horizon. We've discussed the math of the split and the bureaucracy of the QDRO. But there is a darker side to the 401k divorce that we haven't touched on yet, the side involving financial infidelity. What happens when a spouse discovers a secret 401k they never knew existed? What happens when a participant tries to empty the vault before the papers are served? In Part 3, we are going to look at the forensic tools used to uncover the ghost assets. We will explore case studies of couples who thought they knew everything about their partner's finances, only to find a trail of hidden contributions and secret beneficiaries. This is where the story turns from a domestic drama into a financial thriller. If you think the QDRO is complicated, wait until you see what happens when the anti-alienation clause of ERISA meets a spouse determined to hide $1 million. The hunt for the hidden 401k begins in the next chapter. The search for hidden retirement assets is the ultimate scavenger hunt in the high-stakes landscape of 2026 American divorce. When we talk about the anti-alienation clause of the Employee Retirement Income Security Act of 1974, or ERISA, we are talking about a federal shield that was designed to protect a worker's future from creditors, bankruptcy, and even their own bad decisions. However, in a divorce, this shield often feels like a stone wall to the spouse who has been kept in the dark. This clause essentially states that a participant's interest in a 401k plan cannot be assigned or alienated to anyone else. It is a fortress built of federal law. But as we discussed, the Qualified Domestic Relations Order is the only legal battering ram capable of breaching those walls. In the world of American literature and modern cinema, the discovery of a secret asset is often the moment the genre shifts from a domestic drama to a forensic thriller. Imagine a scenario in 2026 involving a couple named David and Jennifer. David has spent 15 years as a senior consultant for a major firm. Throughout their marriage, Jennifer was under the impression that they were living paycheck to paycheck, struggling to keep up with the mortgage on their suburban home in Virginia. But during the discovery phase of their divorce, her legal team uncovers a trail of breadcrumbs leading to an orphan 401k. This is an account from a previous employer that David never rolled over and, more importantly, never disclosed on his financial affidavits. The forensic process of finding these ghost assets is a meticulous, step-by-step operation. It begins with the W-2 audit. In 2026, just as it has been for decades, the W-2 form is a roadmap of a person's financial secrets. Forensic accountants look specifically at Box 12. This is where the codes live. If a spouse sees the letter D in Box 12, that indicates elective deferrals to a 401k plan. If the amounts listed don't match the contributions the spouse claimed to be making, or if the spouse claimed they weren't contributing at all, the financial infidelity is laid bare. By comparing the wages in Box 1, wages, tips, other compensation, with the wages in Box 3, Social Security wages, a professional can often calculate exactly how much was diverted into a tax-deferred shelter. But the hunt doesn't stop at the current employer. Historical trends show that many Americans leave behind a trail of small, forgotten retirement accounts as they hop from job to job. In literature, these are often treated as time capsules of a former life. To find these in a 2026 legal setting, Jennifer's team would use the National Registry of Unclaimed Retirement Benefits or perform a deep dive into David's old bank statements to find automatic transfers to brokerage firms like Vanguard, Charles Schwab, or Fidelity. Even a $5 monthly maintenance fee appearing on a statement from 2018 can be the thread that unravels a hidden $200,000 account. This leads us to the psychological and legal concept of dissipation of assets. If David, sensing the end of the marriage was near, suddenly stopped contributing to the 401k or worse, took an unauthorized withdrawal to hide cash in a non-marital account, he has committed what the courts call waste. In many U.S. jurisdictions, the court has the power to reconstitute the estate. This means if David wasted $50,000 of marital funds, the judge can act as if that money still exists and award Jennifer a larger share of the remaining assets to compensate for his misconduct. This is the moment of judicial karma that serves as a satisfying climax in many legal-themed novels. A critical technicality often ignored in fiction but vital in real-world case studies is the vesting schedule. This is the process by which an employee earns the right to keep the employer match portion of their 401k. Imagine David's company offers a 5% match, but he has to stay for 5 years to be 100% vested. If he and Jennifer divorce in year 4, David is only 80% vested under a graded schedule. The law must then decide, is the non-vested portion considered marital property? In 2026, most states follow the historical trend of considering the non-vested portion as a contingent interest. The QDRO can be written to award Jennifer 50% of whatever eventually vests. This creates a waiting game narrative where the ex-spouses are tethered together by a vesting clock, waiting for a future date to finalize their financial separation. Then there is the issue of separate versus marital property, often referred to as transmutation. Suppose David had $100,000 in his 401k before he even met Jennifer. That $100,000 is his separate property. However, over 20 years of marriage, that money grew due to market performance, and he continued to add marital funds to the same account. The two pools of money, the separate and the marital, have become commingled. In American literature, this commingling is a metaphor for the loss of individual identity within a marriage. Legally, it requires a tracing analysis. A forensic expert must go back through 20 years of statements to apply the Hunt formula or similar calculations to determine how much of the final $1.2 million balance is attributable to the original separate seed, and how much is the fruit of the marital labor. If David cannot prove the separate nature of that initial $100,000 because he threw away his statements from 2005, the court may rule that the entire account has been transmuted into marital property. This is a common tragedy of paperwork, where a character loses a fortune simply because they lacked a filing cabinet. We also have to consider the role of the beneficiary designation. This is a recurring plot device in American inheritance literature. Under ERISA, a spouse has a federal right to be a beneficiary of a 401k. Even if David tries to name his sister or a new girlfriend as the beneficiary while he is still married to Jennifer, that designation is usually void unless Jennifer signs a waiver of spousal interest. But what happens if the divorce is finalized, the QDRO is never filed, and David dies? In many case studies, the plan documents trump the divorce decree. If the 401k paperwork still lists the ex-wife, the plan may be legally obligated to pay her, regardless of what the divorce judge said. This creates a legal ghost scenario where an ex-spouse receives a windfall from beyond the grave, leading to years of litigation between the ex-wife and the grieving family. It is a stark reminder that in the eyes of federal law, the paperwork is the reality. As we look at the evolving landscape of 2026, we see more digital assets and brokerage link features within 401ks that allow participants to trade individual stocks or even crypto-themed ETFs. This adds a layer of volatility risk to the divorce. If the 401k is being split at the height of a bull market, but the QDRO isn't executed until a market crash 6 months later, who bears the loss? Does the ex-spouse get a fixed dollar amount, or a percentage of the account? If the order says Jennifer gets $500,000, and the account drops from $1 million to $800,000, David is left with only $300,000. If the order says she gets 50%, they both share the pain. This choice of wording in the QDRO is where fortunes are made or lost in the silent war of the drafting process. But even if you find every cent, and even if you win the tracing battle, There is a hidden trapdoor in the 401k structure that most people don't see until they've already fallen through it. It involves the loans we discussed in Part 2, but with a terrifying twist involving involuntary distributions and the tax cliff. In Part 4, we are going to explore what happens when the 401k literally explodes during the divorce, triggering massive tax bills that neither spouse can afford to pay. We will look at the case study of the tax debt spiral, and how one wrong move with an IRA rollover can turn $1 million settlement into a nightmare of IRS audits and penalties. The most dangerous part of the 401k divorce isn't the split, it's the aftermath. Stay tuned as we dive into the toxic assets that can poison a divorce settlement for a lifetime. The moment the judge signs the divorce decree in 2026 isn't the finish line. It is the beginning of the most high-stakes administrative race in American law. In the literary landscape of the modern American tragedy, this is the point where the protagonist realizes that a legal victory does not always translate to financial survival. We often see characters in contemporary fiction, like those in the high-pressure worlds created by writers such as Gary Steingart, who view their 401k as a digital safety net. But in a divorce, that net can quickly turn into a tax-deferred time bomb. The aftermath of a 401k split is defined by a phenomenon known as the tax cliff, and understanding its mechanics is the difference between a character who rebuilds and a character who spirals into insolvency. To understand the toxic nature of these assets, we must first look at a secret hidden deep within the Internal Revenue Code, Section 72T, 2C. This is a technicality that functions as a narrative escape hatch in many financial case studies. Most Americans are terrified of touching their retirement funds before age 59 and a half because of the historical trend of the 10% early withdrawal penalty. However, when a distribution is made to an alternate payee, the ex-spouse, pursuant to a qualified domestic relations order, that 10% penalty is waived. This is a unique one-time opportunity to access liquidity that is otherwise locked away. But this opportunity is also a trap for the unwary. Imagine a case study involving a character named Marcus, a 42-year-old project manager in Denver, Colorado, in the year 2026. Marcus is exiting a 15-year marriage to Elena. As part of their settlement, Marcus is awarded $200,000 from Elena's 401k. Marcus is drowning in legal fees and needs a down payment for a new apartment. He decides to take the $200,000 as a direct cash distribution, rather than rolling it over into his own IRA. The step-by-step reality of this decision is brutal. First, the plan administrator is legally required to withhold a mandatory 20% for federal income taxes. Marcus expects a check for $200,000, but he receives a check for $160,000. The remaining $40,000 is sent immediately to the IRS. This is the first moment of shock. But the true tax debt spiral happens at the end of the year. That $200,000 is considered ordinary income. If Marcus already earns $120,000 a year, this distribution pushes his total taxable income to $320,000. In the tax brackets of 2026, he may have moved from a 24% bracket to a 35% bracket. The 20% that was withheld is no longer enough to cover his total tax liability. When April 15th rolls around, Marcus realizes he owes the IRS an additional $30,000 that he has already spent. This is how a settlement that looked like a fresh start becomes a crushing weight of federal debt. In American literature, this scenario is often used to illustrate the theme of financial claustrophobia. The character feels they have escaped the marriage, but they have simply traded one form of bondage for another, the debt to the state. The technicality of the IRA rollover trap adds another layer of complexity. If Marcus had accidentally rolled that $200,000 into an individual retirement account, IRA first, and then tried to take the cash out, the Section 72T divorce exception would have vanished. Once the money hits an IRA, the 10% penalty applies again, regardless of the divorce decree. This is a point of no return that destroys many real-world financial plans. We must also analyze the valuation gap, a period of extreme vulnerability that occurs between the day the couple agrees on a number and the day the money actually moves. Let's look at a scenario in 2026 where the stock market is experiencing high volatility. Elena and Marcus agree on a valuation date of June 1st, when the 401k is worth exactly $400,000. The agreement states Marcus gets 50%, or $200,000. However, the legal process of drafting the QDRO, getting it approved by the plan, and having the judge sign it takes 4 months. By the time the plan administrator is ready to cut the check in October, a market correction has occurred, and the total account value has dropped to $300,000. Who bears the loss? If the QDRO was drafted to give Marcus a fixed dollar amount of $200,000, Elena is left with only $100,000. She has taken a 75% loss while Marcus took zero. Conversely, if the QDRO specified a percentage interest, Marcus would receive $150,000. In 2026, we are seeing a historical trend of litigators fighting over gains and losses language with more ferocity than ever before. If a scriptwriter wants to show a couple at their most petty, they focus on the wording of the earnings and interest clause. This clause determines if Marcus gets the growth that occurred during those 4 months of waiting. Without that clause, Elena keeps every cent of the dividends and interest earned on Marcus's share during the administrative delay. Another toxic asset often found within the 401k structure is the unvested employer match. Many 2026 tech workers have 401ks heavily weighted toward company stock that hasn't fully vested. In a divorce, this is treated as a marital contingent interest. The difficulty lies in the fact that the money doesn't exist yet, but it was earned during the marriage. Literature often uses this to create a ghost of the future. The ex-spouse is awarded a portion of something that might never materialize if the employee is fired or the company goes bankrupt. This creates a psychological tether where the ex-spouse is forced to root for the professional success of a person they may despise, just so their portion of the 401k eventually vests. Furthermore, we must address the anti-alienation conflict. While ERISA protects the 401k from outside creditors, it does not protect it from a spouse with a QDRO. However, if the 401k participant decides to go into bankruptcy during the divorce, the 401k is generally considered an exempt asset. This leads to a strategic maneuver often seen in high-stakes legal thrillers. The participant spouse files for Chapter 7 to wipe out other marital debts while shielding their $1 million 401k. The other spouse, if they haven't secured their QDRO yet, might find themselves standing in a line of creditors, watching the most valuable asset in the marriage sit safely behind an ERISA-protected wall. The depth of this masterclass requires us to look at the forensic accounting of plan loans. In 2026, many 401k plans allow for multiple outstanding loans. If a spouse takes a loan to pay for their own divorce attorney, they are essentially borrowing from the marital pot to fund a war against the other half of that pot. When the court orders the 401k to be split, that loan is often treated as a distribution to the participant. This means the borrowing spouse's share is reduced by the amount of the loan, but they still have to pay the loan back to the plan or face the tax consequences. This creates a double-dip penalty that can leave a character with almost nothing at the end of the day. As we move forward in this series, we have to look beyond the numbers and into the darkest corner of the 401k divorce, the survivor annuity trap. What happens if the person who owns the 401k dies after the divorce is final but before the QDRO is processed? In many 2026 cases, the money doesn't go to the children, and it doesn't go to the estate. It disappears into a legal void or goes to a beneficiary named 20 years ago. In Part 5, we are going to explore the death of the participant and the immediate restraining orders that are necessary to prevent a total loss of assets. We will dive into the specific case studies of the widow by law, where an ex-wife remains the legal beneficiary of a 401k, despite a decade of separation and a signed divorce decree. This is the point where the administrative becomes existential. We will show you why the first thing your lawyer should do isn't filing for divorce, but filing a notice of adverse interest with the plan administrator. The clock is ticking, and in the world of ERISA, death does not wait for a judge's signature. In the high-stakes bureaucracy of 2026, the interval between the finalization of a divorce and the formal execution of a qualified domestic relations order is what legal scholars often call the dead zone. It is a period of administrative vulnerability where the law of the state and the law of the federal government engage in a silent, high-stakes tug-of-war. For a character in a modern American novel, this is the ultimate suspense mechanism. The divorce decree says the marriage is over, the assets are divided, and the parties are free. But in the eyes of the Employee Retirement Income Security Act, or ERISA, that decree is often little more than a piece of paper until it is transformed into a specific, plan-approved order. If the participant spouse dies during this window, the potential outcomes shift from a clean break to a legal catastrophe. Consider the case study of a couple we will call Robert and Susan, residing in Ohio in 2026. After 25 years of marriage, their divorce is finalized in March. The judge signs a decree stating that Susan is entitled to $500,000 from Robert's 401k, which is held at a major financial institution. However, the QDRO is still being drafted by a specialized paralegal. In April, before the document is even sent to the plan administrator for review, Robert unexpectedly passes away. Under the historical trends of federal preemption, Susan may find herself in a terrifying position. Even though she has a court order saying she is the owner of that $500,000, the 401k plan is governed by the plan documents rule. If Robert never updated his beneficiary designation, or if the plan requires a specific type of survivor benefit language that hasn't been filed yet, the plan administrator may be legally required to pay the entire balance to Robert's secondary beneficiary, perhaps a sibling or a new partner. This is the technical reality of ERISA preemption. Federal law overrides state law. In the landmark historical case of Kennedy versus Plan Administrator, the Supreme Court of the United States reinforced this principle, stating that plan administrators must follow the plan documents, not the external divorce decree. For Susan, this means her $500,000 settlement could vanish into a black hole of federal litigation. In literature, this is the administrative ghost that haunts the surviving spouse. It represents the idea that we are never truly free of our past until the federal government says we are. To prevent this in 2026, the step-by-step process requires a move that is often overlooked in domestic fiction, the joinder or the notice of adverse interest. In certain states like California, a joinder is a mandatory procedural step. 401k plan itself is joined as a party to the divorce. This effectively puts the plan on notice that a claim is being made against the assets. In other jurisdictions, a lawyer must immediately send a notice of adverse interest to the plan administrator the moment the divorce is filed. This acts as a legal freeze. It tells the plan, do not distribute any funds, do not allow any loans, and do not change any beneficiaries until we sort this out. Without this freeze, the participant spouse could, in a fit of narrative-driven spite, change their beneficiary to a distant relative or a charity, leaving the ex-spouse to fight a multi-year battle in federal court against an entity that has already paid out the money. Imagine a scenario involving Thomas, a high-earning executive who remarries just weeks after his divorce from his first wife, Diane, is finalized in 2026. Thomas has a $2 million 401k. The divorce decree gives Diane $1 million. But the QDRO is not yet in place. Thomas dies on his honeymoon. Under ERISA, a current spouse has an automatic right to survivor benefits. Now, the 401k plan is caught between the federal rights of the new spouse and the state court-ordered rights of the ex-spouse. This is a classic plot point in the modern financial thriller. The potential outcomes here depend entirely on whether Diane's legal team filed the correct notices to protect her interest as an alternate payee. If they didn't, the new spouse might walk away with the entire $2 million, and Diane is left with a worthless piece of paper signed by a state judge who has no jurisdiction over a federal ERISA plan. The technicality of the survivor annuity further complicates this. Many 401k plans, particularly those that have absorbed older pension assets, are subject to the Qualified Joint and Survivor Annuity or QJSA rules. These rules state that a spouse must be provided with a lifetime annuity if the participant dies. During a divorce, the QDRO must explicitly state that the ex-spouse is to be treated as the surviving spouse for the purposes of these benefits. If the drafter of the QDRO misses this specific phrase, the ex-spouse loses their right to the survivor benefit entirely. It is not enough to say she gets half the account. The document must define her status in the eyes of the federal government. We must also look at the historical trends of the separate interest versus shared payment approaches in the context of death. In a separate interest QDRO, the account is sliced in two, and the ex-spouse becomes the owner of their own independent account. This is the safest route because once the account is split, the death of the original participant has no impact on the ex-spouse's money. However, in a shared payment QDRO, the ex-spouse only receives a portion of each check as the participant receives it. In this scenario, if the participant dies, the payments usually stop. This is a narrative tragedy of the highest order. A character who relies on that monthly 401k check for survival suddenly finds their income stream cut off because their ex-spouse died. All because the QDRO was drafted as a shared payment instead of a separate interest. Step by step, the forensic accountant and the lawyer must also audit the 401k for life insurance features. Some older 401k plans allowed participants to buy life insurance with their pre-tax contributions. If this exists, the divorce settlement must address who pays the premiums and who receives the death benefit. If the participant dies and the policy is still inside the 401k, the distribution of that death benefit is again governed by ERISA, not the divorce decree. This creates a layer of hidden assets that can either save or sink a character's financial future. In the literature of the 21st century, the 401k represents the commodification of the human lifespan. When we divide it, we are dividing the years we have left. When a death occurs before that division is technically perfected, it reveals the fragility of our legal structures. The characters are forced to realize that the judge is not the highest authority. The plan administrator is. The struggle is no longer between two people, but between a person and a set of automated federal regulations. This brings us to a critical realization. The 401k is not just a financial asset. It is a legal entity that exists in a different dimension than the rest of the marital property. You can sell a house, you can split a bank account, and you can drive away in a car the day the judge signs the paper. But the 401k is a tether that remains until the bureaucracy of the QDRO is fully satisfied. But what if the danger isn't death? What if the danger is the market itself? What if, while the lawyers are arguing over the survivor benefit language, the underlying investments in the 401k are tied to a sector that is currently collapsing? In Part 6, we are going to dive into the custodial battle. We will look at how the financial firms, the Vanguards and the BlackRocks of the world, handle these disputes and what happens when the 401k is invested in high-risk, non-traditional assets like private equity or specialized ETFs. We will explore the case studies of the market crash divorce, where the delay in filing a QDRO turns $1 million fortune into a pile of worthless digital receipts. The clock isn't just ticking for the participant, it is ticking for the economy. Stay tuned as we explore the intersection of market volatility and marital dissolution. The intersection of market volatility and marital dissolution is where the abstract world of high finance crashes into the intimate world of the American living room. In the year 2026, we are witnessing a phenomenon that financial historians and literary critics alike are calling the hyperreactive portfolio. Unlike the static pensions of the past, the modern 401k is a living, breathing organism that reacts to global events in real time. When a couple decides to divorce, they aren't just splitting a static pile of money. They are attempting to catch a falling knife. In the deep dive of this masterclass, we must examine the technical mechanisms of the custodial battle and how the delay between a judge's signature and the actual transfer of funds can result in the gain or loss of a decade's worth of labor. Imagine a case study involving a project manager named Tyler based in Austin, Texas. It is early 2026, and Tyler has spent 18 years building a 401k valued at $1.4 million. His portfolio is aggressive, heavily weighted in emerging tech ETFs and specialized AI sector funds. During the divorce mediation with his spouse, Brenda, they agree on a valuation date of March 1st. On that day, the market is at an all-time high. They decide on a 50-50 split, meaning Brenda is slated to receive $700,000. However, the legal system in 2026 still moves at a 20th century pace. The drafting of the Qualified Domestic Relations Order, the review by the plan administrator at a firm like Vanguard or Fidelity, and the final judicial approval take 4 months. During those 4 months, a significant market correction occurs. Tyler's tech-heavy portfolio drops by 22%. By the time the plan administrator is ready to execute the transfer in July, the total account value is no longer $1.4 million. It is $1.09 million. This is the moment where the specific wording of the QDRO determines the future of both parties. If the QDRO was drafted to award Brenda a specific dollar amount, exactly $700,000, Tyler is left with only $392,000. He has absorbed the entire $308,000 market loss himself. If the QDRO had been drafted to award Brenda 50% of the account balance as of the date of distribution, they would have shared the loss, with Brenda receiving roughly $546,000. This technicality is what we call the allocation of risk, and in modern American literature, it is the ultimate plot device for the sudden reversal of fortune. Historical trends show that in high volatility years, the battle over the gains and losses clause becomes the most contentious part of the divorce. This clause dictates whether the alternate payee, in this case Brenda, receives the market appreciation or depreciation on her share of the assets from the valuation date until the distribution date. Without this clause, many plan administrators default to a flat dollar amount, which can be devastating in a bull market for the recipient or catastrophic in a bear market for the participant. Step by step, a professional forensic accountant must track the shadow growth of the segregated funds. In 2026, most major custodians have implemented automated systems to handle these calculations, but the underlying legal instruction must be flawless. If the QDRO is silent on gains and losses, the default plan language takes over, which is often a source of secondary litigation. This leads us to the role of the custodian. Firms like BlackRock and State Street act as the neutral third-party gatekeepers, but their primary loyalty is to the plan documents and federal ERISA regulations, not the individual spouses. When a notice of a pending divorce is filed, the custodian often places a temporary hold on the account. In the world of finance-driven fiction, this is known as the digital freeze. During this freeze, Tyler might be prohibited from reallocating his assets or changing his investment strategy. Imagine if Tyler sees the market correction coming. He wants to move his $1.4 million into the safety of a money market fund or treasury bills. But because of the pending QDRO and the custodial hold, he is locked into his aggressive tech positions. He is forced to watch his net worth evaporate in real time, unable to take defensive action because the account is in legal limbo. This creates a sense of powerlessness that authors use to mirror the emotional paralysis of a failing marriage. We must also explore the complexity of self-directed brokerage accounts or SDBAs within a 401k. By 2026, a significant percentage of high-net-worth 401ks include these windows, allowing participants to invest in individual stocks, precious metals, or even private equity. Splitting an SDBA is a logistical nightmare. Unlike a standard mutual fund, which can be liquidated at the end of the trading day, an SDBA may contain illiquid assets that cannot be easily divided. In these case studies, the court may order a mandatory liquidation, forcing the sale of assets at an inopportune time, or it may require a sophisticated cross-tranching where different types of assets are assigned to different spouses to balance the risk. Consider the scenario where the 401k holds a significant amount of company stock with a low-cost basis. This introduces the concept of net unrealized appreciation, or NUA. If the divorce settlement does not account for the NUA potential, the couple might miss out on a massive tax planning opportunity. Historically, NUA allows a participant to take the company stock out of the 401k and pay ordinary income tax only on the original cost, while paying the much lower capital gains rate on the appreciation. If Brenda receives her share of the 401k via a standard QDRO rollover into an IRA, she loses the NUA tax advantage forever. In the 2026 economic landscape, where tax brackets are a constant concern for the American public, failing to mention NUA in a divorce decree is considered a top-tier professional error. The pacing of the custodial battle is further accelerated by the 2026 trend of the administrative segregation. To minimize their own liability, some plan administrators have begun creating shadow accounts the moment a draft QDRO is received. They move the contested portion into a low-risk, interest-bearing account, while the final legalities are ironed out. While this protects the alternate payee from a market crash, it also strips them of any potential upside during a market rally. This is the financial equivalent of a character being put in witness protection. They are safe, but they are no longer part of the world where growth happens. In American literature, the 401k market battle serves as a metaphor for the unpredictability of life. We spend decades planning for a specific outcome, only to find that the external forces of the global economy have more control over our retirement than our own intentions. The characters in these stories must grapple with the realization that their hard-earned security is tied to a ticker tape that doesn't care about their personal tragedies. The 401k becomes a symbol of the precariousness of the middle-class dream in the 21st century. As we conclude this deep dive into market volatility, we must look at the next inevitable step. Once the assets are identified, valued, and the market risk is allocated, the most formidable opponent of all enters the room: the Internal Revenue Service. The way a 401k is split can trigger tax liabilities that span years, or it can provide a tax-efficient path to a new life. In Part 7, we are going to break down the taxation warfare of the 401k divorce. We will examine the potential outcomes of the 20% mandatory withholding rule, the nuances of the Section 72T exception, and the specific case studies of couples who thought they were getting $1 million, only to realize the IRS was their primary beneficiary. The real cost of a divorce isn't what you pay your lawyer. It is what you pay the government. We will see you in the next part as we navigate the minefield of the 2026 tax code. Taxation warfare in the year 2026 is the final invisible battlefield of the American divorce. When we look at the 401k through the lens of literature, we see a digital account balance that characters mistake for a static pile of gold. But in reality, a 401k is a deferred tax liability masquerading as wealth. The IRS is the silent third party in every mediation session, and they are the only party that never settles for less than their statutory share. To navigate this minefield, we must understand that the nominal value of a retirement account is a fiction. The true value is what remains after the federal and state governments have taken their portion of the harvest. Let us look at a case study involving a character named Rebecca, a 45-year-old marketing executive in Seattle, Washington. In 2026, Rebecca is finalizing her divorce from her husband, David. As part of the settlement, Rebecca is awarded $400,000 from David's $1.2 million 401k. To the casual observer, and perhaps to the author of a less technically rigorous novel, Rebecca just became $400,000 richer. But the taxation reality is far more complex. The first technical hurdle is Internal Revenue Code Section 402(f). This section mandates that any distribution from a qualified plan paid directly to an individual is subject to a mandatory 20% federal income tax withholding. When the plan administrator at David's company receives the court-approved Qualified Domestic Relations Order, they don't simply wire $400,000 to Rebecca's checking account. If Rebecca chooses to take the money as a cash distribution to fund her new life, she will receive a check for $320,000. The remaining $80,000 is sent immediately to the IRS. In the narrative of Rebecca's life, this is the moment of the sudden shrinkage. She planned her budget based on the larger number, but the administrative reality of the tax code has immediately eroded her liquidity. However, the 20% withholding is merely a down payment. This is a crucial distinction that many protagonists in financial dramas fail to realize until the following April. In 2026, federal income tax brackets are progressive. If Rebecca already earns $100,000 a year and takes a $400,000 distribution, her total taxable income for the year balloons to $500,000. This pushes her into the highest marginal tax brackets. Even though $80,000 was withheld, her actual tax liability on that distribution might be closer to 35% or 37% at the federal level, plus any applicable state taxes. Rebecca could find herself owing an additional $60,000 to $70,000 when she files her return. This is the tax debt spiral that can turn a successful settlement into a state of insolvency. Imagine if Rebecca's attorney had utilized the Section 72(t)(2)(c) exception. This is the one genuine advantage of a 401k split during a divorce. Historically, the 10% early withdrawal penalty is the primary deterrent for anyone under the age of 59 and a half looking to access retirement funds. But when money is distributed to an alternate payee via QDRO, this 10% penalty is waived. Rebecca can access that $400,000 without the extra $40,000 penalty that would normally apply. This makes the 401k a more flexible source of cash during a divorce than a traditional IRA, which does not share this specific exception. In American literature, this exception acts as the hidden key, a way for a character in distress to unlock resources that would otherwise be sequestered behind a wall of penalties. But there is a step-by-step technicality that acts as a trap for the unwary: the IRA rollover reversal. If Rebecca, in an attempt to be financially responsible, rolls her $400,000 share into a new individual retirement account, she has technically made a direct rollover. This is a tax-free event and avoids the 20% withholding. However, the moment that money touches the IRA, it loses its status as a QDRO distribution. If Rebecca later realizes she needs $50,000 for a down payment on a home and tries to take it out of her new IRA, she is now subject to the 10% early withdrawal penalty because the 72(t) divorce exception does not apply to IRAs. This is a common technical tragedy in the world of financial planning. A character tries to do the right thing by saving for the future, only to accidentally lock themselves out of their own money or trigger a penalty they could have avoided. We must also consider the after-tax basis and the pro rata rule. Not all money in a 401k is equal. Some 401ks in 2026 allow for after-tax contributions that are not part of a Roth 401k. If David had contributed $50,000 of after-tax money to his account over the years, that money has already been taxed. When the account is split, the tax basis must be tracked. If the QDRO is not drafted to account for the transfer of basis, Rebecca might end up paying taxes on money that should have been tax-free. Forensic accountants in these stories act as the translators, deciphering the cryptic codes on a 1099, are formed to ensure that the tax burden is distributed fairly. The concept of transmuted liability is another deep dive topic. In some historical trends of aggressive litigation, one spouse might argue that they should receive more of the 401k to compensate for the future tax bill. If David keeps the $800,000 remaining in the account, he is keeping $800,000 of future debt. If he retires in 20 years in a lower tax bracket, that money is more valuable to him than it is to Rebecca right now. This leads to the present value versus future liability debate. Lawyers use actuarial tables to determine the current worth of a future tax bill, a process that feels like financial divination. In the landscape of American fiction, the tax code is the ultimate arbiter of truth. A character might lie to their spouse, their children, or their friends, but they cannot lie to the 1040. The 401k divorce reveals the true nature of our relationship with the state. We are all essentially in a long-term partnership with the government, and they are the first ones to get paid when the marriage ends. The stress of these calculations, the 20% withholding, the 72T exceptions, the marginal bracket jumps, creates a unique kind of suburban anxiety. It is the realization that your security is contingent upon your ability to navigate thousands of pages of federal regulations. As we look at the evolving trends of 2026, we see a rise in tax-efficient dissolution strategies. Couples are increasingly using the 401k as a strategic tool to pay off joint debts or fund two separate households with the least amount of friction. But this requires a level of cooperation that is often absent in the heat of a divorce. When one spouse uses the tax code as a weapon, perhaps by timing the distribution to occur in a year when the other spouse has high income, it becomes a form of economic warfare. We have explored the identification of assets, the market risks, the death of a participant, and now the heavy hand of the IRS. But there is one element we haven't touched upon that is the most personal and potentially the most damaging: the administrative human error. What happens when a perfectly drafted QDRO, a favorable market, and a solid tax plan are all ruined by a simple clerical mistake at the company's HR office? In Part 8, we are going to dive into the custodial chaos. We will look at the case studies of the lost QDROs and the administrative nightmare of large corporate mergers. Imagine a scenario where David's company is sold to a multinational conglomerate halfway through the divorce, and the 401k plan is moved to a new provider that doesn't recognize the pending court order. We will explore the step-by-step reality of chasing $1 billion financial institution for your missing $500,000. The machine is vast, and sometimes the most dangerous part of the 401k divorce is simply being forgotten by the system. The battle against the machine begins in the next part. The systemic failure of the administrative machine is the point where the 401k divorce moves from a legal negotiation into a Kafkaesque nightmare. In the year 2026, we are operating in an era of hyperautomation, where most retirement plan record keepers have transitioned to algorithmic processing. However, this shift has created a new kind of institutional friction. When a judge signs a qualified domestic relations order, it is sent into a digital ether where it must be reconciled with a corporate infrastructure that may be in the middle of a total transformation. In modern American literature, this is the archetype of the individual trapped within the gears of a soulless bureaucracy, a theme explored by authors from Herman Melville to David Foster Wallace. The 401k is the contemporary scroll, and the plan administrator is the modern-day Bartleby the Scrivener, except instead of saying he would prefer not to, the system simply generates an automated error code. To understand the custodial chaos of 2026, we must first examine the phenomenon of the record keeper transition. Imagine a case study involving a character named Amanda, a senior architect at a firm in Chicago. Amanda is in the final stages of a 3-year divorce battle with her spouse, Kevin. In early 2026, they finally achieve a court-signed QDRO to split Amanda's $850,000 401k. However, at the exact moment the order is mailed to the plan administrator, Amanda's firm is acquired by a global conglomerate. This acquisition triggers a transition of the entire 401k plan from a legacy provider like Fidelity to a new low-cost institutional record keeper. This creates what is known as a blackout period. A blackout period is a time frame, often lasting several weeks or even months, during which participants cannot make any changes to their accounts, including distributions or investment reallocations. For Amanda and Kevin, the blackout period is a narrative purgatory. The legacy provider no longer has the authority to process the QDRO because the assets are in transit, and the new provider does not yet have the participant data to recognize Amanda as a plan member. In 2026, these blackout periods are increasingly common as corporate mergers and acquisitions reach record levels. Historical trends show that during these transitions, paper-based documents like court orders are frequently lost in the administrative handoff. If the QDRO is lost or ignored during a merger, the step-by-step recovery process is an exercise in legal and financial stamina. First, the attorney must obtain the new plan summary plan description and their specific written QDRO procedures. In 2026, every 401k plan is federally mandated to have a written procedure for determining the qualified status of a domestic relations order. If the new plan administrator uses a different template or requires different technical language than the old plan, the original court order may be rendered obsolete. This requires the lawyers to go back to the judge, amend the order to reflect the new company name and plan name, and restart the months-long approval process. This is the administrative trapdoor that can swallow a year's worth of growth and thousands of dollars in additional legal fees. Furthermore, we must look at the data migration errors that occur within these massive financial institutions. Imagine a scenario where, during the migration from the old provider to the new one, a decimal point is moved or a social security number is incorrectly tagged. In 2026, with the sheer volume of assets being managed by firms like BlackRock and Vanguard, even a 0.01% error rate impacts thousands of people. If Amanda's $850,000 balance is incorrectly recorded as $85,000 in the new system, the QDRO will be processed against the wrong amount. The burden of proof then falls entirely on Amanda to produce decades of paper statements to prove the system's error. In the literature of the 21st century, this represents the loss of the self to the data point. The character is no longer a human with a history, they are a fluctuating balance in a buggy database. This leads us to the conflict of the model language. Many 401k plans in 2026 have adopted a stance of extreme rigidity. They provide a model QDRO form and essentially refuse to accept any order that deviates from their specific wording. If a divorce attorney, attempting to protect a client with custom clauses regarding survivorship or market interest, drafts a bespoke order, the plan administrator may reject it as non-conforming. This is a jurisdictional clash. A state court judge has the power to order the division of property, but federal ERISA law gives the plan administrator the discretion to decide if that order meets the plan's technical requirements. This means a corporate clerk in a cubicle halfway across the country effectively holds a veto power over a state court judge's ruling. In the world of American literature, this power dynamic is used to highlight the fragility of the social contract. The characters believe they have reached a resolution in the courtroom, only to find that the true power lies within the private policies of a multinational corporation. The 401k is the ultimate instrument of this power. It is a private contract protected by federal law, making it nearly untouchable by the traditional mechanisms of local justice. Let us consider the case study of the small business 401k. In many 2026 scenarios, a protagonist might work for a small company where the business owner is also the plan administrator. This creates a massive conflict of interest during a divorce. If the owner is a friend of the participant's spouse, they may engage in administrative foot-dragging, claiming they haven't received the paperwork or that the order is being reviewed by their legal team. Because there is no large, neutral HR department to appeal to, the alternate payee is forced to file a federal lawsuit under ERISA to compel the plan to act. This moves the battle from a local family court to a federal district court, escalating the costs and the stakes to an unsustainable level. The technical reality of the 2026 custodial battle also involves the rise of the EQDRO portal. While these portals are designed to streamline the process, they often act as a barrier to complex settlements. These systems are built for the simple 50-50 split. If a settlement involves a complex formula, such as a specific dollar amount plus a percentage of future vesting plus a carve-out for a prior loan, the automated system may simply be unable to process it. The character is then told that their settlement is unadministrable. This is the ultimate technical defeat. The law says you are entitled to the money, but the software says it cannot move it. As we move toward the final stages of this masterclass, we must recognize that the administrative machine is not just a hurdle. It is the environment in which the modern divorce lives and dies. The successful navigation of a 401k split requires not just a good lawyer, but a forensic understanding of corporate structure and data management. We have seen how assets are hidden, how they are taxed, how market volatility eats them, and how the system loses them. But there is one final overarching conflict that defines the American experience of divorce in 2026: the geography of the law. What happens when the 401k was earned in a community property state like California, but the divorce is happening in an equitable distribution state like New York? What happens when a spouse moves across state lines halfway through the process, triggering a conflict of laws that can change the valuation of the 401k by hundreds of thousands of dollars? In Part 9, we are going to explore the interstate warfare of the 401k. We will look at the case studies of the jurisdiction shoppers and the legal loopholes created by the state line divide. The 401k may be a federal asset, but the hands that reach for it are guided by the conflicting laws of 50 different states. The final battle for the map begins in the next part. The interstate warfare of the 401k divorce in 2026 is a byproduct of the Great Migration of the remote work era. As Americans moved across state lines during the early 2020s, they unknowingly carried their retirement assets into a jurisdictional minefield. While the 401k is governed by federal ERISA law, the definition of what constitutes marital property is left to the states. This creates a legal schizophrenia where the exact same dollar in the exact same Vanguard account can be worth 50 cents to a spouse in one state and 0 cents in another. In American literature, this geographical instability serves as a powerful metaphor for the shifting sands of the American identity. The protagonist is no longer tethered to a specific community or a specific set of rules. They are navigating a map where the borders are financial cliffs. To understand the geography of the law, we must first dive into the fundamental divide between community property states and equitable distribution states. Imagine a case study involving a character named Carlos, a software engineer living in Seattle, Washington, which is a community property state. In 2026, Carlos is divorcing his spouse, Elena. In Washington, the law is refreshingly, or perhaps brutally, simple. All assets acquired during the marriage are owned 50-50 by each spouse. There is no argument over who earned more or who contributed what to the household. If Carlos contributed $100,000 to his 401k while married to Elena, $50,000 belongs to her. However, imagine if Carlos and Elena had lived the first 10 years of their marriage in Florida, an equitable distribution state, before moving to Washington in 2024. This move triggers a conflict of laws that requires a step-by-step forensic reconstruction of their financial timeline. Washington courts use a concept called quasi-community property. This means the court will look at the assets Carlos acquired in Florida and ask, if Carlos had been living in Washington when he earned this money, would it have been community property? This allows the Washington court to treat the Florida-earned 401k funds as if they were earned under Washington law. But if the situation were reversed, if they moved from Washington to Florida, the Florida judge would have the discretion to divide the 401k in a way that is fair but not necessarily equal. Florida law might award Elena 40% or 60% of the account, based on factors like the duration of the marriage or the economic circumstances of each spouse. In literature, this discrepancy creates a narrative of jurisdictional shopping, where the move to a new state is not about a new job or a better life, but about a strategic positioning for a future legal battle. A critical and often overlooked detail in these case studies is the date of separation. This is a technicality that varies wildly from state to state and can change the valuation of a 401k by hundreds of thousands of dollars. In 2026, the historical trend of high volatility markets makes the timing of this date essential. In California, the community property interest in a 401k ends on the date of separation, the day one spouse decides the marriage is over and communicates that intent. If Carlos separates from Elena in June 2026 but doesn't file for divorce until December 2026, any 401k contributions and any market growth on his half of the account during those 6 months are his separate property. Contrast this with a state like New York or Virginia, where the marital interest often continues until the date of filing the divorce summons. If Carlos were in New York, Elena would be entitled to a share of every contribution and every cent of market growth right up until the day the papers are served at the courthouse. For a high earner in a bull market, those 6 months could represent a $50,000 or $100,000 difference. Authors use this timing to create high-tension scenes where characters race to the courthouse or hide their intent to separate until they can maximize their financial position. The 401k is no longer just a retirement fund. It is a ticking clock that rewards the spouse who moves first or who moves to the right state. The multi-state tracing report is the technical tool used by forensic accountants to solve this geographical puzzle. This report is a year-by-year, state-by-state analysis of every contribution made to the 401k. Step by step, the accountant must review W-2 forms, state tax filings, and pay stubs to determine where Carlos was a resident when each dollar was deposited. They must then apply the specific law of that state at that time to that dollar. If Carlos spent 3 years in Texas, community property, 4 years in Illinois, equitable distribution, and 2 years in Nevada, community property, the 401k is divided into tranches. This is what we call the apportionment of the asset. The complexity of this calculation is a goldmine for the modern legal thriller, as a single error in the residency timeline can collapse the entire settlement. We must also examine the inception of title rule versus the apportionment rule. Some states follow the inception of title rule, which suggests that the character of an asset is determined by the state of the marriage when the account was first opened. If Carlos opened his 401k as a single man in a separate property state, some jurisdictions might treat the entire account as separate property, with the marriage only having a right to reimbursement for the contributions made during the union. Other states follow the apportionment rule, where the account is treated as a hybrid asset that grows more marital with every year of the marriage. In 2026, as the workforce becomes more mobile, the clash between these two legal philosophies is becoming a primary source of litigation. The role of the plan administrator in this interstate warfare adds another layer of administrative complexity. Imagine a 401k plan that is based in Delaware, governed by a plan document drafted in New York, and being split by a court order from Arizona for a participant living in Georgia. Which state law governs the interpretation of the QDRO? While ERISA provides a federal framework, it often points back to state law for the definition of marital rights. The plan administrator may refuse to honor an Arizona order if it uses terminology that conflicts with the Delaware-based plan documents. This creates a state line divide that can trap a 401k in a legal no-man land for years. The ex-spouse is left holding a valid state court order that is functionally useless because it cannot cross the digital border into the record-keeper system. In the landscape of American literature, this geographical fragmentation represents the breakdown of the national narrative. We no longer have a single American story of retirement, we have 50 different versions of it, and the one you get depends on where you parked your car when you decided to leave your spouse. The 401k is the ultimate portable asset, but the laws that govern it are stubbornly stationary. This creates a sense of legal vertigo for the characters, who find that their financial security is contingent on a map they no longer understand. As we reach the final stages of this deep dive, we have seen the technical, administrative, and geographical forces that define the 401k divorce in 2026. We have looked at the hidden assets, the tax traps, the market volatility, and the state line warfare. But there is one final dimension that we have yet to explore: the psychological and social aftermath of the empty vault. What happens when the legal battle is over, the 401k is split, and the characters are left to face a retirement that is half of what they imagined? In the final part of our masterclass, Part 10, we are going to explore the endgame. We will look at the case studies of the post-divorce rebuild and the sociological phenomenon of the 401k ghost. We will examine how the division of these assets has fundamentally changed the way Americans view the second half of life. We will also look at the emerging 2026 trends in prenuptial 401k protection and the future of the marital contract in a world of individualized risk. The final chapter of the 401k story is not about the money, but about the lives that are built from the remainders. The conclusion of the masterclass begins now. The conclusion of this journey into the financial heart of American fiction brings us to the moment of the post-divorce rebuild. In the year 2026, the data indicates a rising trend in what sociologists call the silver divorce, where couples over the age of 50 separate after decades of shared financial planning. In the world of literature, this is the ultimate test of a character's resilience. They are no longer looking at a 30-year horizon of compounding interest. They are looking at a 10-year sprint toward a retirement that has been fundamentally altered. The 401k, once a monolithic symbol of shared safety, is now a fragmented asset that must be reconstructed in a landscape of individualized risk. Consider the case study of a character named Sandra, a 58-year-old nurse manager in Philadelphia. In 2026, Sandra finalizes her divorce after 28 years of marriage. The $1.2 million 401k she and her husband built together is split, and after the tax considerations and the qualified domestic relations order fees we discussed in previous parts, she is left with a rollover IRA containing $550,000. For Sandra, the narrative is no longer about growth, It is about recovery and strategy. The step-by-step reality for Sandra in 2026 involves utilizing the catch-up contribution provisions of the Internal Revenue Code. Under the historical trends strengthened by the Secure 2.0 Act, individuals over the age of 50 can contribute significantly more to their 401k and IRA accounts than their younger counterparts. Sandra must now maximize her elective deferrals, pushing her annual 401k contribution to the maximum allowable limit, which in 2026 has been adjusted for inflation. She also utilizes the Roth catch-up requirement for high earners, ensuring that a portion of her late career savings is growing tax-free to mitigate the future tax liabilities she inherited during the split. In American literature, this is the second act, where the protagonist stops living for the collective and starts building a fortress for the individual. However, Sandra faces the psychological ghost of compounding. This is a concept often explored in modern domestic dramas, the haunting realization of what could have been. If Sandra had kept the full $1.2 million, a 7% annual return would generate $84,000 in growth in a single year. With $550,000, that same 7% return only generates $38,500. The math of the split has not just halved her balance, it has fundamentally crippled the engine of her wealth accumulation. This is the compounding gap, a narrative chasm that many characters find impossible to cross. It leads to a shift in the American literary theme from the pursuit of luxury to the pursuit of adequacy. This brings us to a significant historical trend we are seeing in 2026. The rise of the retirement-focused prenuptial agreement. In previous decades, prenups were often about protecting family businesses or real estate. But as the 401k became the primary vehicle for American wealth, the legal focus shifted. Imagine a scenario involving a young professional named Mark, who is entering his first marriage in 2026. Mark has seen the catastrophic potential outcomes of his parents' divorce, and he insists on a separate property carve-out for his 401k. The technical drafting of such an agreement is a masterclass in forensic foresight. Mark's attorney must not only list the current balance of the 401k, but also include a clause that defines all future appreciation on that premarital balance as separate property. This is a direct challenge to the apportionment rule we discussed in Part 9. By 2026, we are seeing more marital contracts that treat the 401k as a sacrosanct asset, immune from the standard equitable distribution laws of the state. This represents a fundamental shift in the American social contract. Marriage is no longer a total economic union, but a partnership with defined exit ramps and protected digital silos. But even with the best legal protection, the vesting cliff remains a narrative trap. In 2026, as the gig economy and high-turnover tech jobs remain the norm, many workers find themselves with a trail of partially vested 401ks. In a divorce, these unvested portions are often treated as contingent assets. If Mark divorces in 3 years, but his employer match doesn't vest for 5, who gets the money? Literature often uses this to highlight the irony of modern labor. The character is working for a future that they may never see, for the benefit of a person they may no longer love. We must also address the sociological impact of the empty vault syndrome. This is the phenomenon where divorced individuals in 2026 are forced to delay retirement indefinitely. We see this reflected in contemporary fiction where the elderly protagonist is still working a service job, not out of passion, but out of a technical necessity created by a QDRO signed 20 years prior. The 401k divorce has created a new class of working retirees, people who are financially solvent but narratively trapped. The data suggests that post-divorce women are particularly vulnerable to this, as they often trade their share of the 401k for the primary residence, only to realize later that you cannot eat home equity. This masterclass has deep dived into the identification, valuation, taxation, and division of the 401k. We have seen how the IRS, the plan administrator, and the state courts all hold a piece of the puzzle. But the final takeaway of this series is that the 401k is the ultimate narrative mirror. It reflects our priorities, our fears, and our failures. In American literature, the 401k has replaced the family farm as the thing we must defend, the thing we must split, and the thing that eventually defines our legacy. As we conclude this 10-part deep dive, we have to look toward the next horizon of financial dissolution. While the 401k remains the king of assets, a new contender is emerging in the 2026 legal landscape: the digital asset portfolio. From cryptocurrency-themed 401k windows to decentralized finance accounts, The next decade of divorce will be defined by assets that have no central plan administrator and no physical jurisdiction. The rules of ERISA are being challenged by the rules of the blockchain, and the next generation of American fiction will be written in the code of the smart contract. If you have stayed with us through all 10 parts of this masterclass, you now possess a forensic understanding of how the most valuable asset in the American household is dismantled. You understand the taxation warfare, the interstate jurisdictional shopping, and the administrative machine that governs your future. But information is only the first step in the rebuild. The real work happens when you log into your portal, look at the balance, and realize that every contribution is a sentence in the story of your life. The story of the 401k divorce is not a tragedy of numbers. It is a drama of lost time. And while we cannot give you back the years spent compounding in a shared account, we have given you the map to navigate the remainders. The era of the individual retirement has arrived, and in 2026, the most important asset you own is not your 401k, but your literacy of the system that controls it. This concludes our deep dive masterclass on the 401k divorce in American literature. Your financial story continues in part 1 of our next series, where we will explore the forensic accounting of the digital estate and the hunt for the Satoshi millions in the modern divorce. The hunt is just beginning.